in line with expectation numbers, a marginal decline in its margins, but the important point was that they have set aside a huge provision of 736 crores. Had some people a bit worried, but let's hear it from the big man himself. Our correspondent Naveen caught up with Keki Mistry and, Ritu Singh caught up with Keki Mistry, and here's a slice of that chat.
Short of meeting its priority sector lending target, then we would be able to sell loans to that bank at a decent spread. So without providing capital, without taking any risks, we get a fairly decent, actually a very decent spread. So if there is a demand for priority sector loans, we would like to sell more loans. So I can't give you the on-balance sheet growth number, but if you look at the off-balance sheet growth, which is you add back the loans sold in the last 12 months, we've always said 15 to 18% is a bare number we think is very certain. I mean, I won't say certain, but it's very likely to happen. We don't believe there is any reason to change that outlook.
What are the cities that are seeing more credit demand in terms of housing, and also on the non-individual side, which are the areas of growth that you've seen, and also for the coming year?
So this quarter, we've seen more growth in the construction finance business. I'm talking of the quarter, and we've seen more growth in the lease rental discounting of products. So lease rental discounting is a little higher, and construction finance is a little higher. Individuals, the growth is coming, believe me, pan-India. But it's not coming from the center of big cities. It is more in the outskirts of big cities. Our average loan amount on an all-India basis is 25 lakhs for new loans we've done this year.
Yes.
Our average loan-to-value ratio at origination is 65%. So we are looking at a property value which is about 38 lakhs of rupees. Now, in the center of any big city in India, be it Mumbai, Delhi, Bangalore, wherever, you'll never get a property of that with that price. So our lending is more in the outskirts of big cities than in the heart of big cities, and there it is almost pan-India. A little slow in some area, a little high in some area, but generally it's there everywhere.
Your spreads and margins have been fairly stable at about 2.94%. Is there room for further expansion from here as we go into the new year?
See, margin expansion can only happen in two ways. It can happen or in three ways. One way it can happen is if we raise equity. So any bank which goes and raises equities, margins suddenly shoot up because you get a lot of zero cost money. There's no cost and you're earning income on that money. We have no plans to raise equity.
Okay.
Second reason margins go up is when interest rates go higher. So when we look at our balance sheet today, we have about 34,000 crores of shareholders' funds. Plus we have another 4 to 5,000 crores of deferred tax liability, where there will never be a tax requirement, but for regulatory reasons, we have to provide for it. So there's a deferred tax liability, there is this provisioning. So all of that is money where there is no cost. The income that we earn on that money, on that free money, reflects the interest rates in the economy. So if interest rates go higher in the economy, we earn more money on the shareholders' funds, where there is zero cost. If interest rates go lower, then we earn lesser money. So that has an impact on margins. So these are really the two factors which have an impact on margins.
So from here it seems with interest rates trending downwards and you have no plans to raise equity, margins would stay in the same range?
Typically would remain in this band, but because of the higher leveraging in the balance sheet, margins could come down by 3-4 basis points a year. That will happen because of higher leveraging, which increases the return on equity. So I think the more important thing to understand is then when margins decline because of higher leveraging or higher debt equity ratio, the return on equity expands. Because on lesser equity, you're sweating lesser equity to create more debt and therefore higher income.
All right, fair point. On your Standard Life IPO, for which you recently got the board approvals, what is the next step? You said you're looking at an IPO in this fiscal itself. What are the regulatory approvals that you have to put in place before that, and any clearer idea of a timeline when you're looking to do the IPO?
So now that we finished the board meeting, we will go through the process of appointing the bankers and appointing the lawyers and starting the offer document. So a lot of preparatory work on the offer document has already been done by the life insurance company, by the people. My sense is that once the offer document is fully ready and is vetted by the lawyers, we will then give it to the insurance regulator, IRDA, and if we can, we will simultaneously file with SEBI. Then it depends on how long the approval process takes.